Economic Armageddon started on the 17th of September 2019. Martin North, John Adams, in the interest of people. Hello, John.
Hello, sir.
Sinister times, then.
Yes. Perhaps today is our most consequential episode. Martin, I have been on a journey since about 2012 when I was starting to get quite concerned about the bubble in Australia in terms of the housing market, and since that time when I was working in Parliament with Senator Dennis, I educated myself and I became more attuned with what happened in the GFC, what's happened post GFC. By 2016, I got frustrated that it was clear to me by then that we were headed towards a train wreck, and that the system, as in the Parliament, the institutions like the RBA, the Treasury, the mainstream media, no one was actually calling out the risks. No one was actually warning the public, and there was no change in public policy that was actually going to save the middle class. So that's when I started writing a series of columns with Daily Telegraph, News.com in 2017-18, and we met it in halfway through 2018. So my whole mission, if I could put it that way. So when people say, do I have a job? I don't have a job, I have a mission. The mission has always been to warn the Australian people about this coming crisis before it actually occurs. Now, the whole premise of the crisis is two statistical facts which are indisputable. One is that Australia has the biggest debt bubble or debt bubbles in Australian history, household debt bubble and foreign debt bubble. And again, just to go back, this was admitted by the Reserve Bank of Australia in 2007, that at that point, bigger than the 1880s and the 1920s, and we are bigger than any time since the arrival of the First Fleet. So that's happening at the same time. We've got the biggest debt bubble in the history of the world. More than 250 trillion, 320% of GDP. It comes from the International Institute for Finance, from a Washington-based organization that's focusing on tracking global debt. And in the course of human history, no economist can point to a case study where this doesn't end in disaster. So all this time where I've been warning the public and we've been doing these shows, I have been saying that the crisis is coming. So today is the day that we say that the crisis has actually started. And it started on the 17th of September 2019, which is a very specific date.
The point I think we should make to the audience here is we're going to do a high-level view today of the reason why we've come to this point.
And we're actually going to explain what has happened, what are the consequences in terms of our analysis, what we've been talking for the last few months, and then what does it mean in terms of the average Aussie who's watching the show. We have had many conversations off camera, and we know that once we make this sort of declaration, there will be people out to attack us, like the AFR, Christopher Joy, Peter Switzer, Koukoulas, all of these people. And so, we have had multiple conversations where we've said, is what we're seeing what we have been forecasting and thinking for quite a while. And so, I want the audience to know that we've come to a mature decision after many months of deliberation on this, and we think that now is the right time to actually warn the public that the crisis that we are now seeing has started. So the analogy would be that if you think about the Titanic, the ship has hit the iceberg. Now, everything seems to be relatively calm. And if you were on the Titanic, if you were up on deck, things would still, you may have felt a bit of a bump when the ship hit the iceberg, but other than that, things seem to be okay. What we're now saying is that things are not okay, and the financial system is on life support.
The band is still playing, things look pretty good, but the water's beginning to sort of creep in underneath, right? What we don't know is the rate of sinkage. Right? We don't know whether this will play out over the medium term or long term. So we're not declaring a particular end date, as it were. But what we're saying is the sequence of events has started and it's definitely going to play out.
I went on national TV about 10, 11 months ago, and I talked about this economic Armageddon. And certain people who watch this show, certain people on social media have said, what happened to your forecast? What happened to the housing crash? What happened to this crisis? It didn't eventuate. Now, 2 points. I never said it was going to happen in 2019, but for those who think that you and I were sensationalists and we said something and we didn't mean it, and then what didn't actually happen. Well, today is the day where we actually say, no, what we said has now started and it will come to pass. Now, where I want to just take the audience is to what I said on the Peter Switzer show when I debated Christopher Joy, because I explained what economic Armageddon was all about. So let's actually play that.
My whole what I've been doing publicly for about 4 years is talking about the quantum of debt in the economy. So we had an admission from the Reserve Bank of Australia in 2007 that the amount of credit in the economy at that point was bigger than the 1880s and the 1920s. And why is that significant? Because we had a depression in 1892, we had a depression in 1931. So RBA says 2007, the debt was bigger than those periods. Well, today, the debt is substantially larger than 2007. So the level of household debt, but also you look at the foreign debt, which is about 57% of GDP, it is the most we've ever had since the First Fleet.
So this is government and private debt, all linked to foreign debt.
Yes. So net foreign debt is over $1 trillion, and gross foreign debt is about $2.3 trillion. This is the biggest amount of domestic level of debt we've ever had, both in nominal terms but in proportional terms as well.
Okay.
But also we have global debt, 80 trillion more than 2007, about $250 billion, $250 trillion, about 300% of GDP.
Okay, John, can you explain the link? Because my viewers, can hear the debt thing. What's the link then between debt, the economy, recession, house prices? Sure.
Okay, so the question is, if we've got the biggest debt bubble in the history of the country, where's the debt? The debt is in property. There's debt bubbles right across the world, and in different economies that's situated in different areas. So the debt bubble is in the housing sector. And what I've argued is, so I've written several columns about economic Armageddon. Armageddon comes when the debt represents a systemic crisis to the Australian economy. So there's a number of scenarios I've written about, and some of them revolve around if we default on the debt. So, for example, if households can't pay their debts and the banks get in trouble, this could lead to extremely sharp falls in property from 40 to 80%, depending if the banks survive. If the banks survive. If the banks survive. No, there are scenarios, just like in 1892, when the banks did not survive, the level of house price falls is even more extreme than, say, Martin North. But if the Reserve Bank, if APRA, if the government steps in with macro intervention, then the question is, well, they could stabilise house prices, and that potentially could be, the falls could be lower than some of the more extreme forecasts, but that comes at a cost. And the cost is the value of the dollar, given the amount of foreign debt we have, because once our international creditors lose confidence in our ability to meet the foreign debt, the dollar, the dollar will crash. So effectively what I'm saying is Armageddon is either, for Australia, a housing crash or a dollar crash. But we can't get out of this problem because the amount of debt in the economy is unparalleled in Australian history.
So, John, I think we should then pause and just recap on what you actually mean by economic Armageddon.
When you have done your Walk the World series and you do your monthly shows, you have your own model about 4 or 5 scenarios as to how you think this crisis is going to play out. Now, you've come at it from a particular lens, and now in 2018, I published my own piece in news.com where I said that Armageddon is going to be one of 6 scenarios. Now, it's either going to be a deflation event or it's going to be some sort of inflation event. We'll put an image of the article up there, and we're also going to put an image of a graph that I publish. It's a bit of a model, and basically I said that Armageddon is going to be one of 6 scenarios. Now we've covered this in previous shows, but I'll just touch on it. So it's basically going to look like it's going to be a debt deflationary depression, a sovereign debt crisis, a local currency crisis, which is a default on the foreign debt. So that's the deflation scenario. Or it's going to be runaway inflation, stagflation, or a global currency crisis.
Those 6 scenarios, they're all basically pretty concerning events which tend to lead us into a rather uncomfortable future.
So one of these 6 events is now going to occur, and the trigger happened on the 17th of September. And so let's actually get into what actually happened on this critical day.
Right, and it's worth saying, I think, that this is all about liquidity, isn't it? It's all about the engine oil of the financial system.
Yes.
And there was some signs potentially of some freezing, some stalling within the system, and in response to that, the Fed started.
there's two interbank lending markets in terms of the United States. There's one where you give an overnight loan with no collateral or no security to the loan, and there's one that you do give collateral. Now, there's an interest rate in both of those markets. So where you give a loan where there's no collateral, that's called the federal funds rate. Where there is collateral in terms of these loans, that's the repo rate. Now, what happened on the 17th of September is that all of a sudden you just had this dramatic shot up in the repo rate from 2.42% to 10%. So that happened on the Monday, Tuesday, and on the previous Friday, the rate was at about 2.16. So you saw from the Friday to the Monday from 2.16 to 2.42, and then all of a sudden on the Tuesday when the market opened, it just shot up to 10%. Now, so that's point one. Now, point two is that with the federal funds rate, so the range in which the central bank wanted the rate to be was to be between 2 and 2.25, and it actually went above that range. So for a moment there, the central bank lost control of its central policy rate. This move from 2.42 to 10% has never happened before in the history of the market. So now, the reason why the rates went up was because of what you said. There was a lack of liquidity. So basically, there were banks with money, with cash, who refused to supply cash to the market, even though as the interest rates were going up, and because of that, the Reserve Bank of New York had to step in and pump $53 billion to keep the market under control. Now, the reason why they had to do that was that if these rates stayed elevated at 10%, that would have meant that banks, hedge funds, and a whole bunch of financial institutions would have had to start paying dramatically high interest rates on this big debt bubble. And the concern was a couple of huge institutions would not have been able to sustain those high interest rates, and that would have led to a declaration of insolvency, and that would have led to contagion, and the market would have collapsed. So that's what this repo crisis is this unparalleled dramatic shoot up in the interest rate. And so since then, the whole name of the game in New York has been to keep these interest rates under control. But to keep them under control, they have done something extraordinary.
Back a decade plus ago, around the GFC, it was again a liquidity crisis that triggered the collapse of banks and then triggered effectively the global financial crisis. So, you can see how close we're getting potentially to another one of those, which is why the Fed then stepped in.
One of the points we need to highlight is that in terms of the repo market, that's where the financial crisis of 2008 started. So when there was a issue with subprime in 2006, that spread into the repo market, and then there was a run on that market that led to some institutions falling over, like Bear Stearns in early 2008. Then that cascaded into Lehman Brothers in terms of September of 2008. So basically, what we're saying is that the key point, the key section of the financial system that blew up in 2006 that led to the GFC blew up again on the 17th of September 2019, and that is the effective Titanic hitting the iceberg, and now it's just a matter of time until the ship, will eventually sink. And because we have a globally integrated financial system, and because we have huge debt bubbles, like particularly foreign debt bubbles in Australia, and we are heavily reliant on the international credit market, whatever happens overseas, whether it's New York or Europe or China or Japan, we are completely vulnerable, and this is where, particularly in the last couple of years, I tried to warn people in Canberra to say we need to become less vulnerable, and nothing has been done to prepare the country for that contagion that could spread right through the system.
Right, and so the New York Fed then started essentially putting funds into the repo market, and that process has gone on and on and on. Okay, it hit a bit of a peak at the end of the year, and it's still there, although slightly at a less aggressive rate now. But meanwhile, the Fed is continuing to pump its own balance sheet higher.
Now, there's a lot of content out there on social media, a lot of other channels, particularly in America, that have talked about this repo crisis. Now, over the Christmas break, I spent about a week and a half locked myself away for about 8-9 days and looked at this very closely. Now, I've written a couple of articles about this, and these articles are going to be the basis of some of our future shows. Now, it is on actually my website, and let's actually put a screenshot of those for people to have a look at now. So there's a 2-part series that I wrote. But yeah, so we will go through some of this detail now, and we are basically saying that the 17th of September is when this repo crisis actually started. We had this unparalleled move in the market. Then we had the injection of 53 billion on the day, on the 17th of September. Now, the officials at Treasury, at the US Federal Reserve and others was basically saying there was a couple of technical problems in the plumbing of the financial system in this particular market, but there was nothing to see. So, so basically we just have to, put a bit of money in, calm everyone down, and then the show will go on. So initially and even CNBC, they all sort of gave some excuses to basically calm everyone down. Now, some of the excuses that they gave initially was that we have the end of quarter reporting obligations, and so under Dodd-Frank, the banks have to hold a certain level of cash reserves, and so the banks with the cash, the reason why they didn't put that into the market to keep these interest rates down was they needed that cash to meet the reporting obligation. So that was issue one. And then in terms of the second excuse, it was the end of tax. So the end of quarter tax obligations. So coming up to the end of September, a number of these banks had to pay huge tax bills. So they needed that cash to be able to pay those bills. And then you had a third reason was that under Trump, they're running huge deficits. And when the Treasury is issuing new bonds, there is a sucking sound of cash out of the banking system into the Treasury to basically fund these deficits, and the deficits themselves was the contributor to cash being tight. And those were the three factors that were said that when these three things happen all at once, that was the reason why. When the repo rate was going up, the banks could not provide cash. Now, but basically they said that initially we need to just provide some funds to the market for a couple of weeks to the end of September. Once we get over these end of quarter humps, everything's fine. Then we get to the end of the quarter and they say, we just need to extend a little bit to the 10th of October. And then everything should be fine. And things will go back to normal. We get to I think a day or two before the 10th of October, and then they say, look, the market hasn't stabilized yet. We need to go into November. We get into November, and then they say, it appears now we have a couple of end of year issues, so we just have to continue to the end of December, but by January, everything will be fine. So we get to the end of December, and nothing, so there was a few people who said that the end of year, something was going to blow up huge in the financial system, so nothing blew up. But we get to January, and when the FOMC and the US Federal Reserve have their January meeting, they basically say that these repo operations, and we'll get into some explanation as to what they actually are, this injection of liquidity into the market, now it has to go out to April. We've had a series of commitments from the central bank and the government to say that no crisis, a couple of short-term factors that happen all at once, and we just have to inject some cash now. And then it's like every time they put a new deadline to say this is when we're going to stop and things will return to normal, they can't stop and they have to keep on going. And that's probably one of the more important factors that came for us to have this conversation, in the sense that when you have a government who keeps on coming up with excuses and those excuses don't hold water, there is something deeper that is happening in terms of below the surface. And obviously, no doubt, Martin, if we were on the Titanic and we spoke to the staff of the ship or to the captain, we heard a bump, we felt a bump. What is it? They would say, a bit of issues with the engine down below, nothing to see here. Why don't you get back to the party and everything should be fine? before September, they were shrinking their balance sheet under quantitative tightening. Now, the tightening process stopped around early August. And they started putting a little bit of money into the system, but from the 17th of September, the amount of money they have injected into the market has been astronomical. Now, overnight repos is where you give a loan on an overnight basis, and then the next day they pay you back. Now, as of the 14th of February, so last Friday, US time, the amount of overnight repos that the central bank has injected into the market to these banks was in the order of about more than $47.6 billion. So that's the overnight component. Now, there's a term repo, which is more than overnight, and it's of a particular term. So these term repos so over the last 4 months, there's been different stages, but what we're seeing at the moment is effectively 4 cycles of 2-week loans. And this is what the term repos, and each of these repos is about 30 billion each. So in total, that's about 120 billion. Now, starting around October, there was an announcement that they were going to do permanent purchases of T-bills. So T-bills are bonds basically with a maturity of 1 year or less. So since this crisis occurred, they've bought more than $354.94 billion. So when you consider overnight repos, term repos, and these permanent purchases of T-bills, we get to a figure of 522.59 billion. Now, important point to say is that this was the figure as of Friday last week. And so every day there are new injections of money. We've had more than $500 billion pumped into this market, and that is not stopping. And that is, that's effectively the crisis.
So, John, the obvious question then is, if that 522 billion hadn't been injected into the marketplace, what would have happened?
What we would have seen, Martin, is we would have seen interest rates, they would have been much more elevated. So the short-term interest rates in the money markets, so the repo rate and the federal funds rate. Now, what we would have seen is that financial institutions with huge amounts of debt would not have been able to pay the interest in terms of these elevated rates. And you would have seen a declaration of insolvency from one or multiple organisations. Now, the key question has been, well, who was in trouble? So if banks were not providing liquidity because they didn't trust the banks or the collateral, someone must have been in trouble. And whoever was in trouble, that was going to be the most obvious candidate to declare insolvency. So the question is who? So a lot of speculation in 2019 that it was going to be someone like a Deutsche Bank through the foreign exchange market. That could have been the trigger. Now, the Bank for International Settlements came out on the 8th of December with a blog post, and they came up with their own interpretation, and they said it wasn't a bank, it was multiple hedge funds. Now, in 1998, we had long-term capital management. That was a huge hedge fund with a couple of like PhD economists, very famous people who come up with particularly financial models, and those financial models could basically guess the market, and they were making a lot of money. But then a couple of very statistically unique events happened, and they basically just ruined all their leveraged bets. And then they were basically on the verge of bankruptcy. Now, in 1998, so there could be some people who watch this show who are aware of Jim Rickards, who's a famous author who's been writing about this coming crisis. Jim Rickards was actually the legal counsel of long-term capital management. And so at that time, all the banks had to basically chip in to bail out long-term capital management. Now, what the Bank for International Settlement said is that in what they said in December was that around this September period, you would have had not one of these long-term capital management organizations, you would have had multiple of them, multiple hedge funds with huge amounts of debt, with huge amounts of derivatives, would have declared insolvency, would have been insolvent, and that would have led to basically a collapse of the system. Because once they default, basically who the money because they've borrowed a lot of money, who they've lent it from, they basically will have to suffer losses, and then those losses will basically start to spread. And then once you get a globally important systemically bank declaring insolvency, that's when the entire financial system will implode. So what we're saying is that had this $500 billion not been injected, one or multiple, assuming the Bank for International Settlements is correct, one or multiple hedge funds would have declared insolvency. That would have led to counterparty defaults with one or multiple banks. And one of these banks, probably a Deutsche Bank or a JP Morgan, etc., would have been declared insolvent, and that would have been enough to destroy the financial system.
So, John, it occurs to me that one of the really interesting things here is that trust degraded, which is why the repo market went all haywire, right? The Fed really hasn't, though, been able to re-establish trust between the counterparties in the financial system, which means this is going to go on for a long time, isn't it?
Yeah. So what happened on the 17th was banks or financial institutions stopped trusting each other, and that's why one or multiple banks with a lot of cash refused to supply cash to the market, and that's why the repo rate in particular went sky high from 2.42 to 10%. Now, part of the role of the Fed was to inject money to get these interest rates back down to something more normal, where the system can handle these interest rates, so they don't want them too high. But part of the explanation from the Federal Reserve was that by injecting money into the market, we can calm everyone down, and we can basically re-establish trust in the market, so that the banks with the cash can start to supply those entities or hedge funds, etc., who want cash. That normal lending process, that could happen. So one of the reasons why I think it's that led me to say that we can now make this sort of significant declaration is that after 4 or 5 months and after $500 billion of injections, the central bank and the government of the United States has not been able to re-establish trust among the players. And so, because if trust was had they been able to re-establish trust, they would have basically stopped pumping the money into the system, and basically those entities that want money, like hedge funds, that they would be able to get the money from the primary dealers who have this surplus cash. So the fact that process hasn't happened, it means that the system or the government and the central bank hasn't been able to re-establish trust, and it means that rather than a short-term blimp, we have a more systemic problem that after 4 months of huge injections of capital, and again these injections will continue going forward, trust has not been re-established in the market, and that suggests to me kind of like what happened in 2006. Trust was evaporated in the subprime market in terms of subprime repos, and basically nothing could be done to re-establish trust because the housing prices were falling, the subprime mortgages were, the delinquencies and defaults were going up, and it just cascaded and kept on building, and then it led to these more systemic events. So the fact, in the financial system, if trust is lost, if trust can be reestablished, that's hugely critical, because a lot of economists talk about confidence. Confidence and trust is so important. But what we can say is that after 4 or 5 months of operations, the players in the market still don't trust each other, and that's why these ongoing injections of capital are still required.
And that means that as the balance sheet continues to rise, that shows you that the trust is still decaying.
Absolutely.
So until we see the balance sheet turning down, this is going to continue.
Yep. And what does that mean for Australia? That would have meant that because we are so reliant on international credit would have seized up. We would not have been able to get credit. So you think about our banks and how much short-term credit, and we've talked about this, about the short-term nature of our foreign debt. We would not have been able to turn over these loans. Our loans would have been caught in. The banks would not have been able to pay these loans. Our big four banks would have imploded, and basically the economy, we would have been in free fall. So some people think that this is theoretical, but we should just spend a moment on this. What we are saying is that had $500 billion in New York not been printed in the last 4 or 5 months, the big four banks in Australia would have collapsed, and we would have been in a full-on depression. What we're saying is that households in Australia that have huge mortgages would have been basically no buffer to cover their debts. We would see people lose jobs overnight. We would see a huge spike in suicide. we would see social chaos, and that's what Armageddon has always been. It's not just an economic collapse; it is the huge social cost that comes with an economic collapse. So I want to just try to emphasise to our viewers to say that we were at a fork in the road in September. Had a couple of things played differently, your life today, what you think your life is, and your surroundings, and your relative wealth, and your social status, all that everything would have been fundamentally turned on. It would have been turned upside down. And if you think you're prosperous and you've got a couple of properties and you've got some mortgages and you think you're fine, you would have been you could have been dead from suicide, or you could be basically out on the street, and we could have seen a big homeless crisis. So when I think about this, because I'm more of a theoretical economist, we can think about these in theoretical terms and talk about parts of the financial system, etc. But one of the failings of economists, one of the failings of economists generally is that they tend to be too inhumane in terms of thinking about this from a mechanical point of view. But I think it has to be emphasised that part of my driver and part of your driver in doing these series is we have a social conscience, and what we're saying is that the social cost of what we've been trying to warn about this social and economic horror, it would be out on the streets today in Australia, and we would have seen social chaos, from homelessness to unemployment to crime to children going hungry. That could have happened today in February 2020 had some certain things in September of 2019 not happen in New York.
Yeah, and John, to my mind, think what was it like down on the south coast post the bushfires. The social issues there. They couldn't pay for anything other than in cash, couldn't move around, people were stranded. It's happened, right? And that was a small local crisis.
Yes.
So people need to understand that what we're talking about is a crisis of huge proportions, right?
And the impact would have been much bigger than the bushfires.
Correct. And that's the point. So we dodged a bullet for now. Without that liquidity injection, the banks here would have been in significant difficulty. We don't know whether, the full impact, because of course the money did get put in, right? But that money is still being pumped into the system now.
Yes.
So the system is on effectively life support, and it's worth just thinking about this for a second. The Fed is now buying bills. In other words, the Treasury is writing money, and then the Fed is buying it.
Yes.
Right? So they're supporting this ever higher debt bomb, right? And they can't stop.
The whole promise by the officials starting from September was that this was always short-term in nature, and that we can return back to something normal. Well, after $500 billion, you had the chairman of the Federal Reserve last week saying that, that we can't normalise interest rates. So I wrote, I think in 2016, criticising the RBA that we can't normalise interest rates. So we are now stuck in this low interest rate environment where we have to keep on pumping money into the system, because if we do not, the financial system, the economy, the world as we know it will basically come to an end.
And we're supporting hedge funds, in other words, highly speculative financial institutions around the world taking big bets, one against the other and against the banking system, right?
Yeah.
It's supporting those globally significantly important banks, which are effectively the pillars of the financial system. So we've got central banks now continuing to support the financial system, but at the cost of real people.
If New York blows up, if the financial system blows up, just like we described, and nothing was done domestically to save the banks, the big four banks would have gone, and the share market would have already been down 80%, and the property market would be on its way to falling 80%. Now, had they actually used these techniques, so obviously a lot of our viewers are very interested in why this cash ban, why the bail-in, negative interest rates, all of this. Had they injected all of this stuff? Now, they could. So we obviously in that situation, we don't know if they can or cannot save the banks. So obviously I think they're hoping that they can save the banks. So assuming they save the banks, well, kind of like what I said in my debate against Christopher Joy, the fall would not be 80% in property, but it would be significant. It would be in the 40% that and in terms of Steve Keen has said, it'd be around that range. So the leap between a 40% fall and 80% fall is, do you save the banks? And obviously this is where all of our commentary about the banks and negative interest rate, all of this, that's why it's important. But when people have sort of said in some of these social media posts or comments on our YouTube, you made a declaration, or you said a number of things in 2018-19, and now everything you have said doesn't seem to have stacked up. What we are saying is that without $500 billion, what we said in the last couple of years would be reality today. Now, like you said, the financial system, it is on life support. They can't stop. Now, one of the things, so if you go back to my 6 scenarios, and we go through looking at hyperinflation, stagflation, or a global currency crisis. So just like I said in my debate against Christopher Joy, so you can print money, you can inject liquidity into the market, but that's not a costless exercise. That comes at a cost, and the ultimate cost is the value of the currency, whether it's the Australian dollar, whether it's the American dollar, the euro, etc. So it would appear to me that if you look at my 6 scenarios, given where we are today, we are more headed towards a scenario of 4 to 6, which is going to be some sort of a currency debasement, inflation, currency sort of crisis. So the key question then becomes, Martin, is, well, how long does that take between now and then before the people, the average citizen, but the financial markets start to wake up to the fact that the confetti, and it's important that we call this out, that the third show that we did was when we held a couple of coffee cups and we had a $5 note and a $10 note, and we did that on Walk the World, and you replayed it on in the interest of the people about halfway through last year. Once people realize that these pieces of plastic or paper, or if it's in digital form, that's worthless, that's when we're going to have some sort of currency crisis, and that is a different type of Armageddon compared to a full-on depression. The ship has hit the iceberg. The ship is basically, they're pumping money out, they're pumping water out of the ship like crazy to keep it afloat. So far, so good, but at some point, that's going to come to an end, and what we don't know is how long is that going to take. Now, so there's in the next few episodes we're going to go through a lot more detail, because I think for a lot of people who don't understand financial markets or economics, we've said a lot of stuff, and it's going to take a lot of time for people to get their head around what we've just said. But here we are. This is the declaration we've made. And no doubt, people like Mr. Koukoulas have called us house price terrorists because they've said that we were overly pessimistic about housing and property and in terms of household debt. But what we are now saying publicly is that the crisis that we said was coming has started. And what I will say is, when I was in Parliament last week, I had a meeting with an MP who I've had multiple discussions about this economic crisis, and he asked me, well, when's it coming? I said it started. And we went through a little bit about this repo situation. And where we ended the conversation, so he was completely blindsided by this. He didn't even know about the repo crisis and what's happened in the repo market and the plumbing of the financial system or anything like that. And when I stood up to walk out to my next meeting, I said to this Liberal MP, I said, the most dangerous thing is that the Prime Minister and the Treasurer have no idea what's going on.
Yeah. The band is playing. I can hear them. The question is, how long have we got?
That's right.
We'll come back to that, John, in the next episode, I guess.
Yeah.
Martin North, John Adams. In the interest of people, we'll see you next time.